So your VA mortgage payment jumped $278 a month and you have no idea why. You didn't refinance, your interest rate didn't change. What gives? Well, the likely culprit is your escrow, or what your servicer calls an impound account. It's the part of your payment that covers your taxes and insurance, and it's the number one reason veterans get blindsided by big payment spikes. So tonight we're going to break down everything you need to know about a VA loan escrow account, how they work, what can go wrong, how to read your escrow analysis, and whether you should waive it altogether or if that's even possible. So if you got a VA loan or you plan to use one, this is the episode that hopefully will save you from getting blindsided by one of those $300, $400, $500 surprises. So tonight I am joined by Mike Alberico in Raleigh, North Carolina, Jason Rivera down in San Diego, and Rocky Bellore in Michigan. So we've got all parts of the country covered, but we're just going to cover one topic here. So Jason, why don't you walk us through, there's the terminology there. Just escrow means a lot of different things. So when someone's talking about an escrow impound account like we're talking about tonight, what is that and how does it vary from the different types of escrow accounts there are?
Well, something that we always talk with our buyers right out the gate, like in our buyer seminar, we always go over the term escrow, because in California, the term escrow can have a couple different meanings. There's escrow as an entity. That's the business that's kind of acting as a third party managing the process. In most states, that is title, but here in California, we have title and escrow. They kind of break up those jobs or what they're supposed to do as two different entities. Then we have escrow as the process. So in other states, it's just your closing process from start A to Z. In California, we have the escrow process, just kind of breaks it down. And then lastly is the escrow, such as the impound account. So when a buyer is going through the process, they're going to hear escrow, like, hey, escrow is now open. You're going to get contacted by escrow. And then the lender is going to be like, hey, we're working to fund your impound account, your escrow account for taxes, insurance, and so forth. And so it can be a little bit confusing, especially for buyers here in California.
Perfect. So Mike, what we're talking about tonight is that piggy bank, the escrow impound account. What does that piece of it mean before we jump into how it can be problematic with changes to taxes and insurance?
So, I mean, basically it's set it and forget it for your mortgage payment. And that set it and forget it, it's a limited time. It's about a year, because we'll do an escrow analysis once a year to what we're going to talk about down the road and changes. So every month, if you have an escrow account, it'll be consistent of 4 factors: your principal and interest payment, which is repaying your mortgage. If you're on a fixed rate mortgage, that can never change for the life of the loan until you pay it off. You get prepaid, you can't pay less. Then the other 2 factors will be, most of the time, homeowners or hazard insurance and your property taxes. One key thing to throw in there is it's going to vary from location and municipality. So I'm originally from Western Pennsylvania. My father still lives there. He has multiple taxes. He has school tax, county, and some of my other family members have borough taxes. So you might see those broken out or lump sum. Now in North Carolina, for example, you might have 3 types of insurance. You have your normal hazard, which is your fire insurance, covers break-ins, fires, etc. Wind and hail, which it covers named storms on the eastern part of the U.S. And you might have flood insurance, and flood can be anywhere. There's parts of central NC that you might think, oh, it's just a creek, but you need flood insurance. So when I say there's 4 things, most time it's just principal, interest, taxes, insurance. But key thing when you're talking to your real estate agent or your loan officer is to pay attention to what other taxes and insurances you might need on your particular property.
So when we have the account, so one of the big misconceptions, you guys probably get the same question I get all the time. Well, I'm not putting 20% down. That means I have to have an impound account. And that's generally people talking about conventional loans. But in reference to a VA loan, Rocky, does the VA require an impound account? And if not, who does require these impound accounts?
Yeah, great question. No, they do not require an escrow account or an impound account. It's typically the lenders that require this. And, this has been a long-standing thing for as long as I've been in the industry. Now, we have our set lenders that we know that we can go to that are going to not give us a hassle and allow us to waive those escrows. But yeah, I know you're absolutely right. Usually they're thinking of the conventional factor.
And I would say most veterans have been told all along that either of the VA requires it or it's just required. It's just this thought out there. So from you guys' perspective, we all know the biggest lender in the country, United Wholesale, with many, if not most, VA loans does not require them. How many other lenders out there don't require them? Because I would say still, wouldn't you guys say the majority of lenders around the country and lenders that we work with on the wholesale side do require them, especially if you're putting little to no money down?
Yeah, some of them will allow you to waive them if you can prove that the veteran is 100%. Has a 100% disability rating through the VA, but even that's a chore to get it done, right?
And we're going to go through it. I would say the majority of people, I don't know about you guys, but for me, I would say 95% of clients, even when they have the option, are going to choose to have it. So we're going to go through the pros and cons of why you would choose to, why most people do, and some of the benefits otherwise. I wanted to throw an example in here, just kind of put some numbers to what Mike was talking about. And I threw in a Texas purchase because Texas can get real expensive on both insurance and on the property taxes. So a $450,000 purchase at today's interest rates with no money down, 0 down, gives you a principal and interest payment a little over $2,600. At 2.25% on the taxes, which is kind of middle of the road for Texas, you got $843 there. And then insurance could be anywhere from $150 to $350 a month. I put in $175. That tells us $1,018 of that goes into this impound account. So your mortgage payment, $2,626, as Mike said, that can't change if you have a fixed rate. I mean, if you had some type of variable rate, at some point in the future, it could change, but that is fixed. The portion that can change is the impound, because both the property taxes and the insurance can change over time. So Jason, when you talk about your home buyer course, what does a buyer need to be prepared with at closing? Because this is where we get a lot of confusion. People have an idea of, okay, we're going to put it into my payment, but they don't really understand what that means, what happens at closing, at settlement, to make sure that there is enough in that account to make sure that we have the money to pay the taxes and insurance when those renewals come due.
Well, we're talking, I mean, closing cost, right? So your closing cost, a lot of times I think veterans or individuals think that closing cost is really just the fees that are to get the loan. I don't think they're really realizing that, honestly, like, a huge portion of the closing cost is funding this impound account, and especially depending on what time of the year and where they're buying at, based off the tax year. Between insurance, they're paying for the whole year up front, plus funding the difference from when they're purchasing, and then also the taxes that can be several thousands of dollars. Specifically here in California, we have the supplemental tax bill. So depending on how the loan officer calculates the impound account, some will kind of calculate for that supplemental tax bill, and some will not. And what that supplemental tax bill is we have one of the very few things that California has going for us is Prop 13 that allows us to basically your property tax is calculated off the purchase price, and then it stops. It essentially doesn't get reassessed unless you do a major remodel or sell that home. And then the new buyer would then get reassessed at that new value. However, when you're buying that home from the prior seller, the seller is probably paying property tax on, I don't know, just for example, a $200,000 home. And now you're buying that home from them at $500,000. Well, there is a delta of $300,000. So at some point, the initial taxes that you paid were at that 200, and now the tax assessor is going to come to you and say, there is a delta. This is the supplemental tax bill. And it's always a surprise unless you happen to have a real estate agent or a loan officer that is familiar with California and says, hey, be prepared. And this doesn't happen right after you close. It doesn't even sometimes happen 6 months after you close. Sometimes it can be a whole year, and you've moved into this home, completely forgot about this conversation, and all of a sudden the tax assessor goes, hey, you have a bill for $3,000, $4,000. unlike your impound account or your escrow account is going to cover your annual property taxes, but it doesn't cover, they won't pay the supplemental tax bill. The supplemental tax bill goes to you, the individual. If your loan officer had padded the account for the supplemental, you would call your servicer and say, hey, I got my supplemental, and they can either pay it or you'll end up getting a refund. Now let me back up here. Sometimes you'll get that refund because, as Mike had mentioned, they will do an account analysis once a year. And so if your supplemental hasn't come in and you haven't had to pay this at the end of the year, if that account was padded for the supplemental, they're going to give you a refund at, $3,000 to $4,000. And you might be like, hey, like it's time to go, Christmas shopping or whatever the case may be. Just realize that money was set aside for the supplemental, and that's that bill. If you haven't received it, it will be coming in California.
In terms of it closing, they're going to collect
Yep.
a number of months of taxes. So it should be done. The underwriter should insist that it's done the right way, where we're collecting, California in general, 1.25, could be higher, could be a little bit lower if you can prove that it's lower, but we're going to collect a number of months at closing. We're going to collect that 12 months of the first year's premium, and then a couple of months on top of that. So in a second, we'll kind of go into, because that can create some confusion oftentimes with people, but California, forget the supplemental piece of it. The wisdom of California is our property taxes are due twice a year. So you would say, oh, every 6 months I have a property tax bill. We don't. They're due in November and then again in February. So we have this short time frame. So unfortunately, we have to look at a chart, unless you want to remember and memorize all 12 months, where sometimes of the year there's 7 or 8 months of taxes collected at closing. Other times of the year it's 3 and 4 months. Mike, for North Carolina, how does that look for you guys? How often are property taxes paid, and is it a little bit easier to be able to explain to a borrower what's going to be collected at closing to establish that impound property tax wise?
Yeah, for sure. I'm going to add on one thing to Jason real quick. For anybody that's watching this that owns a home, or if you're buying one, if you get a large refund, please call your servicer, your loan officer, before you go Christmas shopping, or like before you spend that money, because mistakes can get made on the servicing side, unfortunately. So before you go and blow all that money and then come back, it's like, oh crap, there's a second bill due. Always check. North Carolina is a little easier. So tax bills, we only have county taxes. Certain coastal communities have additional like town taxes, but most of the time in North Carolina, we have 100 counties. It's all one bill. They normally come out end of July, early August. They're not considered late until the first week of January. So most servicers will pay those from mid-November to the end of December. So it's pretty easy to see that. And the biggest thing with us is, so if you're buying a house now, it's 2025, the 2025 tax bill's out, the one that's due in January. We don't know what 2026 is yet, because there might be some changes. If we voted on a bond in a particular county, we can go down the road about reassessments, because that's what we've dealt with a lot in North Carolina, is population growth and property value has gone up significantly. So we've had lots of reassessments, which has contributed to escrows increasing, but it's pretty easy to figure out the prorations. And North Carolina is called an attorney state. So we use title insurance, but unlike having a title company or an escrow company, a real estate attorney does closing, and they'll do the prorations and everything like that. So it's pretty straightforward. You close today. Happy Veterans Day, everybody. November 11th, you get a credit from the sellers from January 1 to November 10th. And if the bill's due, they're going to collect today through the rest of the year and put in a cushion for next year, starting that escrow account. So that's one thing I will say is North Carolina is a lot easier on that aspect, because there's not really any changes when a property is bought and sold, and you're not going to see another bill until next year.
And you had mentioned Pennsylvania. Pennsylvania is a pain in the butt because there are these multiples, and sometimes those are even due at different times. So depending on where you are, this can be very easy for your loan officer to explain to you and very easy for you to understand, or much more difficult. Rocky, in Michigan, you guys have townships, and do the townships have separate taxes as well, or are you guys just looking at county taxes?
So we do county is winter, city is summer for taxes. So it's going to be July 1st, the summer taxes are due, and then December 1st for winter. But yeah, no, there's a township also if you live in a township. Yeah, absolutely.
So it's an important piece, and I don't think anyone, the big piece of kind of going around the horn and going through it, if you're watching at home, this probably shouldn't make sense to you. It's complicated. Many loan officers can't explain it. Hopefully the one you're working with can, and can walk you through this, what it means in your state and the time of year that you are closing. One of the things that I get, probably the question about 1 billion times a year, is why are you charging me twice for insurance? I see it in this box, and then I see it in this box. So with that, Jason, what does that collecting look like there at closing? So we talked about it. So one is really what? The first 12 months there, the first year's premium. What's the other amount? And am I getting double charged when I see it in two separate line items?
No, I actually had this question myself long ago. So you're paying for the first year upfront, and whenever you pay for it, you're going to have a renewal period. So I don't know, it's the December, closing December, you're paying in December, it's going to renew again in December, but then your first payment isn't till, I don't know, January.
February 1 normally.
Yeah, let's say 1 February. So you have 2 months difference. So you're gonna pay a portion from the time you close to that first payment for the insurance, because then once you start your monthly payment, that's when that impound, like they're taking a portion of your monthly payment to fund the insurance, but they need to have enough money in the insurance or in that section for the impound account. So when they get to December, they're not short. And if you only paid for the month or for the year up front and then didn't make your first payment to February, you would come up short by 2 months, 3 months, somewhere around there. And that's the reason why you get double funded. Now that's an example, but if it's somewhere like in the middle of the year, it could be drastically different.
So I think we have a pretty solid idea in understanding an explanation of what goes into it. What do I need to fund at closing? What is it? What goes in there? Rocky, why is this such an issue that people are talking about? What in the world happened? I just got a notice from my lender. I have a fixed rate, and I don't understand why my payment went up $300. What in the heck is going on, and how is it possible that your lender can raise your payment $100, $200? I've seen it's $700, $800 on bigger mortgages.
Easily. Yeah, no, great question. And this is a call that we frequently get, usually around the same time of the year. What's happening is that, there's an escrow shortage, and the mortgage company will take care of that on your behalf, but they want to make sure that not only do you pay them back for the amount that they covered, but they also want to make sure that your payment is reflecting the new tax amount that they're going to have to disperse. So that can account for sometimes $400 or $500 an increase per month. And I get it. I mean, that can be jading. It can be really, really tough to swallow that pill. But that's essentially what's happening. A lot of times people will call up frantically saying, I thought my rate was locked. What's going on? And it's understandable, especially for first-time home buyers. It's a new process, right? So.
And we have two pieces. I mean, for the longest time, this kind of blew my mind. Over the last couple of years, my homeowner's insurance, my house hasn't moved. My house hasn't changed in composition. It is worth more, but insurance has just gone through the roof. And so I actually went back and looked. We bought in 2003, so 22 years ago, for approximately 18, 19 years. In total, my homeowner's insurance had gone up 10%. And then one year it went up 25%, and the next year it went up 30%, and the next year it went up 30% again. So it's almost doubled in the last 3 years. Part of that is I probably need to start shopping because you can see bigger variances. So if you get this, it could literally just be that your insurance has changed massively. I have a client in Florida that they had to get a new roof. It was a $52,000 roof. But by doing that roof, they went from $15,000 your homeowner insurance down to $3,000. So there's, depending on where you are, can be huge amounts, huge variances. You need to shop it, but that's a big chunk of it. But Mike, why don't you go into a little bit more detail? You had talked about the reassessment because there's two pieces that are causing people problems with this annual analysis, where the lender's calling up and saying, hey, we don't have enough in your impound account. And borrowers want to say, well, how'd you screw that up? And well, it's a moving target. They didn't necessarily screw it up. So we talked about homeowners insurance spiking over the last few years, but what's happening on the property tax side?
Yeah, and just to add on to the insurance, I mean, unfortunately, if you have a claim, your insurance can go up. So you might see that going down the road, but we're all paying for all these natural disasters that have happened all over the country through our insurance. And like you mentioned, the roof, that's they're being more in depth on how they assess these. They're, citing inflation of rebuilding a property at a total loss. And that's why you're seeing a lot of insurance go up. But taxes, so I'm in central North Carolina in Raleigh, so it's called the Triangle area. If you look at, I'm sure all of us have because we're in the real estate industry, my area consistently is in the top 3 of best places to move to, which is fantastic for my business until I go out and drive down a street here and I'm like, all right, enough people. Point being with that is the values are going up. The assessments are going up. So in my area, they only assess, it used to be every, I think, 5 years. Now it's every, I think, 3 to 4 years. So what they do is, and this is a key thing to look at, and it's going to, of course, we're going to sound like a broken record, vary based off municipality and where you're at. So in North Carolina, just because you pay $700,000 for a house, the county might have it assessed at $600,000. Which is fantastic. A lot of times you'll see it assessed less, which is the only time you want your home to be worth less is when in the eyes of the government. So there's still going to have fluctuations in there. And the biggest thing with the difference in taxes is we talk about assessments, values go up, the tax values based off a percentage where you're at, whatever the county and city that you're in determine is needed. And you might see small changes throughout the year. Like a lot of those things, when you go to the ballot box and don't pay attention to, like, oh, let's do a school and park bond. Well, that money comes from somewhere. So you might see small changes to your tax bill from items like that. But the biggest thing is assessments. And if they change the millage rate, and what that is in plain English is the percentage that they utilize for taxes versus the value that they say your house is worth. So we've ran into this a few times because we just went through a major assessment in North Carolina where it hadn't been touched in a few years. After COVID, property values went up, people moved in the area, property values went up again. So there were, honestly, when bills came out, I think it was like last year, maybe 2 years ago, I probably got 30 calls that month. What happened? Well, let's go look at your tax bill. In most areas, for the people watching, tax bills are public record. You can go pull them yourself. Some areas they charge for them, but most of the time you can just find the county site. And the reason I bring that up is your loan professionals will help you, but if you're ever curious, you can just go straight. Like I'm in Wake County, North Carolina. Go Wake County right now and pull my neighbor's tax bill, my tax bill, and see how it's changed throughout the years.
And it's something you should ask both your lender and or your realtor is how often do we get reassessed? So California, because of Prop 13, they reassess every year, but it's capped. So you don't really notice. It's just going up little tiny amounts. Some areas assess every year, some 2 years, 3 years, 5 years. So the reason why home values really spiked in 2020, 2021, in the early part of 2022. But now this is becoming a problem because the areas that didn't reassess for 3, 4, 5 years. So people were very happy. Hey, my home doubled in value. That's awesome. And they look and they go, my property tax bill doubled. That is far less awesome than my house doubling. So these not only catch you off guard, the lender, the servicer that you pay your payments to, they're not looking forward. They're not going, hey, what's this going to be next year? They wait till the bills arrive. And once a year, they have to do this analysis for a couple of reasons. One, like Rocky said, to make sure that there's enough in that account to pay it. but then also to make sure that they don't have too much. The government says there's only so much they can have in that account, and they have to do a forward-looking 12-month analysis. Hey, are we getting shorted so that the borrower doesn't have enough in here to pay their taxes and or their insurance? And then also, do we have too much where we're going to get a slap on the wrist for taking too much money from the client? So we're going to get that analysis every 12 months. You can protect yourself a little bit by making sure you're looking at your homeowner's insurance bill. And if the thing went up from $2,000 to $3,000, you probably have a real good idea that you're going to be about $1,000 short when that reassessment or when the analysis comes through. And same thing with your property taxes. If you get a new property tax bill and you see that it went up a bunch, there was no way for the servicer to predict that. So they're just going to do this, unemotional, dispassionate analysis. And this is what the numbers tell us. And they're going to give you two options. One of them, you can write us a check and we can get back to even, or we'll spread it out over the next 12 payments. And that's what most of you are seeing. Hey, my payment went up $112. I looked at mine as we were preparing for this, and I found out that I am $86 short. It doesn't come up for a month or two. And I'm like, well, $86 in the grand scheme of things could be a lot worse, because just like you guys get this a whole heck of a lot. So big
One
picture.
thing real quick, Josh.
Yeah.
We said bill a lot, and just a little tidbit for everybody out there. If you have an escrow account, you're still going to get bills. Your lending servicer will still get bills too, because that's a common question that we get from a lending side. I'm sure Josh, you and Rocky have got it. Jason, you'll start getting those as well. It's paid through the mortgage. Why did the county send me a bill for $7,000? Why did the insurance company send me a bill for $2,000? You're still going to get copies. They'll be paid, but it's still your responsibility to also monitor those to make sure they get paid. Sorry, go ahead.
No, that's a really good point, because it's very rare, but any of us who've been in the business for a long time, I've had a situation where the servicer didn't pay the taxes. I mean, they made good on it. I don't know how they screwed it up, but a year went by and the taxes weren't paid, and they had to pay it and pay the late fees because the borrower had done what they were supposed to and put the money into the account every month. So definitely something important to look at. So I had mentioned earlier, and would you guys agree? Probably 95% of clients want the impound account, or you guys see a higher percentage of clients that are asking to not have their taxes and insurance included?
In my case, it's mainly higher net worth clients don't want it because they tend to have higher valued properties, and those tax and insurance bills can be pretty significant. And they're at the mindset that I'll just pay this on my own. But even if I make a few percentage points in a money market account, I want to hold on to it. And most of the time it comes down to personal preference, but I'm with you that I'd say 95% just, they got enough going on with life. They don't want to worry about separate bills. Or a lot of people forget about it and they're like, oh yeah, I'll pay it on my own. And they get blindsided with a $7,500 bill.
Well, I have a client here in California, a veteran. It's a $1.3 million property. The taxes are $15,000 a year. And I said, are you certain that twice a year you want a $7,500 bill showing up on your door and you're responsible for it? And he went through it and hemmed and hawed, and he goes, yeah, I'm going to. So he's about a year into it. So I need to call him back and ask if he's still happy to get a $15,000 bill split into 2 installments. With that, so why don't we go through this? There's a lot of information out there. When we were going to do a topic like this, I always like to look and say, what's popular, what's out there online. And I found a video that had 100-something thousand views on it of a guy saying, never under any circumstances have an escrow impound account. So I have a number of cons that he had listed here. But Rocky, what are the biggest positives or the pros that a borrower gets out of having an escrow impound account?
Yeah, no, great question. For me, it's out of mind, out of sight. It's one less thing you have to deal with, especially if finances are tight, having to make sure that you save up and account for that money, put it aside just so that you can pay the tax bill when it's due. This way, it's one payment, it gets sent out, it's forensically audited once a year. They're going to make sure and give you an escrow analysis. It's perfect if that's what you're looking for. But no, for me, my first home, my second home, I escrowed. After that, for different reasons, I chose to take care of it on my own. But It was
But
awesome.
it's funny. I was going to ask. I was asked the question of what you guys do, and I'll tell you. My first property, we had them impounded, and then we bought the second home. I'm like, that sucks. That's a lot of money. I want to have that money under my control. And so we bought in 2003, and we ended up refinancing in 2004, 2005. And I went back to having the impounds because I'm like, it's not a big deal one way or the other. But I didn't like my tax bill at that time was like $2,000 twice a year, and I'm like, this is not fun having to come up with an extra $2,000. Just mentally for me, it was easier to add an extra $350 a month to the payment than to come up with $2,000 twice a year. So just the simplicity, it goes in there, set it and forget it. For first-time buyers, I think this is great. Like you're new to this. Like if on your second loan you decide you want to go and go alone a little bit better, but you don't ever have to worry about. I've had clients. I'm sure we've all had clients call up and go, "Oh my God, I haven't had homeowners insurance for the last 6 months." And their lender calls them and goes, "Hey, what's your deal? You don't have homeowners insurance. It lapsed. There was a problem." This way you can make sure that it's always paid. It's always in force. Jason,
Most lenders, Josh, if you're a first-time buyer, at least the ones that I work with will require it, even if they allow it to be waived on conventional or VA. If it's your first time, they kind of want that extra layer of security. Like, we're going to handle this next house. You can do it.
I think it's just a best practice. I'm sure there are youngsters out there buying their first home. Well, the average age is what, 38, 40 now. So most first time buyers, but still it's just a good process to go through with that. Jason, how about this? You want to be devil's advocate? You want to take the flip side here. What are some terrible things about that escrow impound account that you might say, I don't want it. I don't want to have that included in the monthly payment?
Well, you're relying on a servicer, whoever that servicer might be, to do proper accounting, and regardless if they account for it properly or not, you're still responsible. That's probably my biggest pet peeve. I've had an impound account, but out of the homes I own now, not one of them is in an impound account. Mainly because as I just said, the improper accounting, you get someone you don't get a choice, right? So you have a third party that's supposed to, audit the impound account and hopefully account for upcoming taxes and insurance. And then they make a mistake or they don't account for something. And then you go a whole year and all of a sudden now,
Jason, I think we lost your audio.
You muted yourself, bud.
He said, I'm going to say something brilliant and I don't want you guys to hear.
Not yet, bud.
back.
There you are.
Okay.
Yeah.
That was weird. It showed it wasn't muted, but anyway, I'm not sure where I left off, but basically, whoever your servicer is, they do this audit, they might make a mistake. A year later, you find out that, hey, there's been a mistake, and now I'm the one being held responsible. The servicer's like, well, you're the one short. So the complacency of feeling like, hey, I don't have to think about it, I think is actually where the problem lies, right? Because a lot of first-time homebuyers are like, hey, it's being taken care of, and they go, and then all of a sudden, their mortgage drops or goes up a little bit, but it didn't go up enough, or it went down and no one told them that, hey, your mortgage is never going to go down. And they go a year thinking everything's good to go, and then all of a sudden, hey, now it went up $1,000, and they're freaking out. And it's like, well, if you've been logging into your service account and looking at your impound escrow account, and you're looking at the tax bill, you would have realized that, hey, or your insurance company went up. It feels like it takes away responsibility when the reality is you're still responsible.
Jason, we went from your mic going silent on you to now it's giving us a bunch of feedback now. So I don't know where we went with that. But those 100% correct. And I would say one of the biggest things when I hear someone say that they don't want it is, well, I don't want that. I don't want this to show up and say, hey, your payment's going up $250. Your payment's going up $500. The payment shock, you can avoid that. You can avoid the mortgage servicer ever telling you that your payment's going up. But the underlying things that are happening, the taxes and the insurance, they're going to change regardless. So to me, from that perspective, that is a con that gets thrown out there, a negative to having an impound account. I go, well, I get it. It's just you're going to be paying the bigger bill somewhere else. The big one that people like to throw out is, well, that's a lot of money and I'm not getting any interest on that money. So you guys tell me what your thoughts are on this, but I always go through it. We're in California. A lot of these people mentioned the guy $15,000 a year tax bill. So it's $1,000 a month, more than $1,000 a month going in there. So $1,300. But we've got to remember that it's not like $15,000 goes in that account at the beginning of the year. And lots of parts of the country, maybe your tax bill is $2,500 and your homeowner's insurance is $1,000. So at its peak, it's going to have $3,500 in the account, but it's going in there 1/12 at a time. So it's not like we have this big sum of money. And federal law does not require the mortgage servicers to pay you interest on that. Many states do have their own laws. I think California is 2% simple interest on it. So you're getting money on it. But I look at the end of the year, it always makes me laugh. I get my statement from them and it says they paid me like $1.42 in interest. And it's like, if you are such an advanced investor that these little chunks that you could invest them throughout the year and get a return that makes it worth it. But I think you guys can see we kind of went around the horn here and we've got differences of opinion, whether we want to keep them separate or put it together. And with the VA loan, some lenders, some servicers are okay with you having the ability to waive it. For those that do allow us to not have the taxes and insurance impounded on the VA loans, Mike, what type of requirements do they have in there? You talked about first-time buyer requirement. Is there equity requirements, credit score requirements? Are they looking and measuring the borrower in any way to determine who they will allow to not impound?
It comes up not too often with me. Like when UWM, Rocky, is there a equity requirement?
Yeah, so you have to put down at least 5% down to waive escrows. If it's 3% down, it's not even allowed. And that's not even a UWM thing. It's a Fannie thing.
Gotcha. Yeah, most of the time, like I said earlier, you can't be a first-time buyer. They're just one, especially if you're using 100% financing, it's just a little more risk on the servicer. I've gotten some waived at 100% that weren't first-time buyers, and the lender didn't even offer it. I just called my account executive. They ran it up the chain, and it was just case-by-case basis. One thing that has all but eliminated in our industry is they used to charge a fee for waiving escrows. I don't know if anybody still does that or not, because most of the lenders that I work with personally do not. So that's one thing. If
they're still out there, Mike. I got on the wrong side of I got on the wrong side of one a couple of months ago. I said, "Oh yeah, there's no charge for it," and then it turns around and there was. We had to eat it for the borrower.
For the home buyers and consumers out there, if you do want to waive it, always ask if there's an escrow waiver fee. It can be 25 basis points. What that means in English is 0.25% of your loan amount is what the charge can be. So like, $250 on a $100,000 loan, but most of them have gone away. So that's one thing that I would ask is that, but it's going to highly vary from servicer to servicer. One thing that can't ever be waived is flood insurance. I think, is that federal law that it can't be waived?
I don't know what the requirement is, but it's part of that where it has to be paid. You can't pay the premium through closing if it's the NFIP policy. So I'm not sure of the why.
I don't know the why. I just know that even if they want to waive everything, I've ran into that scenario a couple of times, once on VA, but multiple times on conventional. And they're like, "Oh, I'll pay it on my own." It's like, sorry, it's flood insurance. You can't.
Yeah.
So we actually have an excellent leading question here from Gary Foote. He wants to know what happens to escrow money if there's a refinance or an IRRRL. As loan officers, especially when rates have dipped like they have recently, this is one of the more fun or unpleasant explanations to go through with the client of explaining what happens with this impound account. Rocky, how do you go through that with clients in terms of explaining to them, hey, I've got X number of dollars in my current impound account and you're wanting X number of dollars more? Did we lose your audio too, Rocky? How about Jason? Or is your mic good, or we still have the
I don't know.
static?
Let's see. Am I staticky?
No, we're yeah. I think we're good from
Okay.
that end. So in terms of going through that in a refinance situation where we have a current impound account and we want or need the impound account on the new loan, how does that work? Can the funds just be moved from one to the new one, or do we have to reestablish? And what does that all entail?
So I've been told that in some cases it can be rolled over. So your existing, I think if it's through the same servicer and you're doing an IRRRL, you can use your existing impound account can roll into the new loan. But for most individuals, at least the people that I've seen do IRRRLs, including myself, you're reestablishing your impound account. And so what that means is even though you may have $10,000 sitting in your impound account. If you're doing an IRRRL with Mike, he's like, all right, well, your closing cost, to refund everything is going to be $13,000. You're like, well, wait, why do I have to pay $13,000? And then Mike's going to be like, hey, don't worry about it. And, within a month, your current servicer is going to send you a refund of that amount. And so you'll get that $10,000. It doesn't belong to the servicer. They don't get to keep it. It's just unfortunate that you can't always just move it over.
And I don't know what you guys are seeing, but the servicers have been pretty aggressive here the last couple of years when we get these rate dips about trying to go and retain their clients. But I see a lot of loan estimates from them, and they're not showing transferring the impounds, which is kind of surprising to me. Freedom is a big servicer, and I've looked at several loan estimates from them recently where they're not transferring them. So it's less common than it was. Most people don't end up going back to the same servicer. A couple of strategies that can be useful in that situation. I had one in Texas last year, $400,000 house that had almost $14,000 a year tax bill, and we were at the end of the year. So he had $12,000 in that impound account, and the taxes were coming due before we closed. So in that situation, he called the current servicer and said, hey, my tax bill is technically due. It's not late. It's not that penalty period that we referenced. And they were able and willing to make that payment early. They did ask him if he was refinancing. They did try to sell him a refinance while he was doing that, but he was kind enough to stick through the process with us. And I've got another situation, a veteran in San Jose that we're going to be closing here in the next 10 days or so, $13,000 a year in property taxes. So he was looking at it and he called up and same thing. They asked, are you refinancing? And they wanted to give him numbers on that, but they did pay the $6,300 bill. So in that situation, his refund from the impound account is going to be $6,300 light, but he's also going to have to bring in $6,300 less at closing. So it all goes back to your loan officer walking you through when are taxes due in your area, when is title going to require those to be paid, and what does it look like? But if you're in an area with high property taxes, it can absolutely be an issue for you at closing.
Man, that's super smart. I never thought of having the client do that because we are in refi rough territory right now because all the tax bills are due and they're not paid. So everybody gets that, talk about payment shock. It's more like sticker shock. Like Jason said, 12 G's at closing. Why? Yeah. But yeah, you can ask if you're doing an IRRRL right now, you can ask them to either, I forget who said it, servicer to servicer, they can potentially transfer it. One other thing you can do if you're doing a refinance, and it's also up to that loan servicer as well, you can ask them to net escrows into payoff. So what that means is, just using round numbers, if you owe $100,000 at closing, you have $5,000 in your escrow account, they can apply that to the principal so that your payoff's lower for when you go to a refinance.
How many servicers have you seen willing to cooperate with that or do it that way, Mike?
Right, 10, 15%.
But if you don't ask, the answer is always no. Yeah. And it's definitely worth asking because it does make a big difference. And yeah, with the VA loan where there's not a max loan amount on the IRRRL, you can absolutely do that. Anything that you guys feel like we haven't covered in terms of this that a veteran should know about the pros and cons of impounds, things that can jump up and bite them, things to be aware of?
Rocky, are you back yet?
Yeah, I can hear it.
I'd say there's some, this might be, California always has unique, I'm sure every state does, but I know like the San Diego trash was paid through your property tax, and the city just did away with they started charging homeowners now for the trash, but it's still going to be inside their property tax bill, and it will be based on how many cans they have. So that could be a variable, you know, instead of just being a 1.25% or 1.2% plus whatever your bonds and maybe Melrose, you also now might have a variable like trash.
At the end of the day, what I would say with this, and we're probably can close it out with this, if you are getting a VA loan and you're refinancing or you're putting 5% or more down, talk to your lender. If you're open to not having them impounded, go through the pros and the cons. But regardless, you need to rely on your professionals, your realtor, your lender, to walk you through this, explain what goes into it, what does it mean. And a lot of this doesn't make sense. It's some of the things that we as lenders and realtors go through all the time of having to explain over and over again, because it's complex. It's not rocket science, but it's complex, and it's not something that necessarily makes sense. So hopefully you're working with pros who can walk you through this, like the gentleman we have here with us tonight. We will be back next Tuesday with another set of pros to cover another topic. So we appreciate you watching and appreciate the three of you for being here and sharing your knowledge with us tonight. Have a good night, gentlemen.
Thanks, Jeff.